In this guide to navigating your employee benefits, we're going to talk through retirement plans, everything you need to know when you're making your elections. So we'll begin the conversation first with a broad brush overview of defined benefit plans, and then we'll shift and spend most of our time on the defined contribution plan since it's a lot more prevalent among employers today. So let's begin with that defined benefit plan, and it's essentially a pension, a promise to pay the employee a fixed retirement benefit upon their retirement based upon several factors such as their years of service within the company, so how long they worked for the company, their age, what time do they retire within their life, in addition to their salary while being employed, how much money did they make while working for that employer, among other things. And pensions are far less common these days as they were in the past, and typically we see them among government run entities. So your teachers, your firefighters, your policemen, etc. They're rare in the private sector. And there's a few different variations of defined benefit plans, such as your traditional, your money purchase plan, your cash balance plan. But again, a few people have the benefit of getting a pension upon retirement that provides that guaranteed amount of income each year. So that's a little bit about your defined benefit plan. And now let's shift to the defined contribution plan and think of your traditional 401k. We'll first talk about the contributions, then we'll go into the tax features, and then finally we'll talk about investment selection and what you should consider there. So let's begin with contributions. So money that you put into the 401k is salary deferral. So once you elect into your 401k, you designate a certain percentage of your paycheck to go into that plan. And the higher percentage that you designate, the more that is pulled from your paycheck, i.e. the less that goes into your bank account each month, and vice versa. So if you designate a low percentage to the 401k, you're going to get more in your bank account. And this is really important to note because you want to be intentional on that contribution amount. It's key to understand your cash flow and what you can afford to put into the 401k in relation to the other expenses you have, because often you won't be able to access the 401k for sometimes decades, depending on how long you're going to work and what age you are, because there's penalties for accessing the 401k prior to age 59 and a half. So contributing too much to the onset could hurt you financially if you don't have an emergency fund and not having enough to live on with your paycheck. So you could always start on the lower end, get a feel for cash flow, and then increase that over time. Obviously, you want to contribute as much as you can to the 401k, and 10 to 15% is a healthy contribution rate, but it's important to be cognizant of how the contribution is going to affect your cash flow. In addition, with the contributions, you have maximum limits. So for 2024, you can contribute up to $23,000 if you're under the age of 50. And then if you're age 50 or older, you can put in an additional $7,500 as a catch-up contribution for a total of $30,500. So you have a maximum contribution limit. And then there's also matches generally with employers. And it's very key to understand what your employer match is, because at a minimum, you want to contribute the full amount needed to get the employer match. You never want to leave free money on the table. And the match terms will vary. It could be dollar for dollar or 50 cents on the dollar. So make sure you read your employee benefits package carefully to understand the provisions of the match. So now let's talk about tax features, and we'll begin with contributions. So contributions to a 401k can either be pre-tax Roth or what's called after-tax non-Roth. So pre-tax contribution is a contribution that lowers your taxes. So you get a deduction, and this shows up on box 1 of your W-2. It's actually lower than the other boxes. So you put money into a 401k pre-tax, you're going to save money in taxes that year. On the other hand, a Roth contribution is after tax. So you're not going to get any tax deduction when you contribute to your Roth 401k. You're putting in after tax dollars. And then finally, there's another version of a contribution called like an after tax non-Roth. And this is more rare. So not all employers offer the after tax non-Roth option. but it's essentially putting money into an after-tax bucket similar to a Roth, but it's a separate type of contribution. And I'll go into that a little bit later in the mega backdoor Roth opportunity. But those are the three types of contributions to the 401k plan. So in addition to the contributions, you have growth. And for retirement plans, it's tax deferred. So if you have a traditional brokerage account, you're taxed each year on your interest, dividends, and stock sales, your capital gains. But while putting money into a 401k and investing that over time, the growth on that investments, the growth on the stocks, the dividends, the interest income, all of that is tax deferred while in that accumulation phase. And then the final tax feature is the withdrawals. So the taxation of the withdrawal is going to depend on whether it was pre-tax money in the 401k or Roth money or after-tax non-Roth money, as mentioned here. So your pre-tax withdrawals, because you got a deduction up front by contributing pre-tax to the 401k, when you withdraw the money, it's taxable to you. So the IRS says, we gave you a benefit up front, we're going to tax you on the back end. In contrast, a Roth taxation comes tax-free to you. So since you didn't get that deduction up front for contributing to the Roth, you receive the benefit of tax-free withdrawals upon retirement. And then after-tax non-Roth is a mixture of that. So essentially, you're putting money in after-tax to the after-tax non-Roth, and you can take that out tax-free, but your earnings on the after-tax non-Roth contributions are taxable. And that's essentially what I summed up right here. Pre-tax, taxable upon withdrawals, Roth, tax-free upon withdrawals, and then after-tax non-Roth mixed. And that relates to the mega backdoor Roth strategy with the after-tax non-Roth. So what some employers allow you to do is put money into the after-tax non-Roth bucket and then do an in-service conversion with those contributions. And if you do that, you can essentially move money out of that after-tax bucket into the Roth bucket and then pay a little tax on the earnings if the conversion is done fairly immediately. And then you won't have as steep of a tax on the earnings with the after-tax non-Roth. And then the final leg of the stool we'll talk about is your investment selection. So the first thing to know here is your asset allocation. And asset allocation is just a funny word for what's your mix of stocks, bonds, and cash. And this is important to understand because stocks carry a little more risk, but have the higher opportunity for growth, whereas bonds provide more stability and less room for appreciation. And then cash, of course, is your stable source that is not going to grow as much, but will help be there in the event that the market declines and keep your portfolio afloat. So it's really important to be intentional around your mix to stocks, bonds, and cash. And the general principle is while you're young and you have a long time horizon to retirement, you can afford a higher allocation to stocks and you want to grow your money at a higher click over time. And then as you shift closer to retirement, most people tend to make their portfolio more conservative. And the reason for that is you don't have that extended time horizon. You have a shorter runway to where you're actually going to be needing the money. So you don't want to be as risky with the portfolio allocation. So again, to summarize, younger people typically have a higher allocation to stocks. And then as you get closer to retirement, shifting more towards those more stable investments like bonds and cash to be in anticipation of needing that money for your retirement. So that's a little bit about asset allocation. The next component there is your risk tolerance. So what's your willingness and ability to accept financial risk? Can you stomach the stock market declining 20% in 1 year? Do you have the financial wherewithal to take on risk? So this should also be included in the conversation when thinking about your investment selection. And then the final piece here is whether you want to pursue active or passive management of your retirement plan. So an active managed sleep portfolio says that of your list of funds within your 401k plan, you're going to individually select the funds and build your own customized portfolio. So with this, you're responsible for doing the research on each fund and making sure you're properly diversified and have enough in each sector of the market. So it takes a little bit more research and acumen on investments and a little bit more time consuming. The other side of the coin is passive management, where you put your 401k allocated in like a target date fund, for example, and all you're focused on is just contributing to the account, and you let someone else, a professional money manager, make those portfolio decisions and make sure you're properly diversified and have a right asset allocation for where you're at within your retirement cycle. So that's a little bit about retirement plans in a nutshell, and I hope this was helpful.